Here's the math nobody wants to do. If you're 55 years old and your portfolio drops 50%, you need a 100% return just to break even. And at your age, compounding doesn't have enough time left to bail you out. That's not a theory. That's what happened to millions of people in 2008. And right now, every signal I track says we're setting up for something bigger. I'm going to show you 4 specific assets that have preserved wealth through every major debt crisis in the last 100 years. Not theories, actual assets with tickers, allocations, and a month-by-month plan you can start this week. But first, you need to understand why this time is structurally different, because once you see the mechanism, you can't unsee it. The economy runs on 3 overlapping cycles. You've probably heard of 2 of them. Productivity growth, are we producing more value per person than last year? Short-term debt cycles of 5 to 8 years. The economy expands, people borrow, central banks raise rates, spending slows, rates get cut. Repeat. That's why recessions come roughly every 7 to 10 years. It's not random. It's the machine cycling. But there's a third cycle underneath all of it that most people never see. The long-term debt cycle. Over decades, debt accumulates, government, corporate, consumer, year after year, until you hit a point where it's mathematically unsustainable. You can't grow out of it. You can't refinance it because rates are already near zero. The debt just sits there, compounding until the machine breaks. That's where we are right now. In 2026, total US debt, government, corporate, and consumer combined, exceeds $90 trillion. Government debt alone is $38 trillion, or 125% of GDP. And here's the number that should stop you cold. The federal government now spends over $1 trillion per year just on interest payments. Not defense, not education, not infrastructure, just interest. For the first time in modern history, interest costs exceed what we spend on national defense. When the debt service bill is larger than the military budget, you're not looking at a political problem. You're looking at an arithmetic problem, and arithmetic always wins. When a long-term debt cycle reaches this point, there are only 3 exits. Default, governments and corporations stop paying, bankruptcy cascades through the system, massive wealth destruction. Restructuring, creditors accept 50 cents on the dollar, paid out over 20 years. Sounds civilized until you realize if you're the lender, you just lost half your money. Or inflation, print enough currency and the debt becomes worthless in real terms. The $100,000 you owed in 2020 is pocket change by 2030 because the currency collapsed. Great if you're a debtor, catastrophic if you've spent 30 years saving. Which option do central banks always choose? Inflation, every single time. They won't call it that. They'll call it quantitative easing, monetary accommodation, stimulus. But strip away the language and it means one thing: the dollars in your retirement account buy less. Sometimes a lot less. I've studied 500 years of economic history. The pattern is always the same. This is stage 7 of an 8-stage long-term debt cycle. The last time this cycle completed was the 1930s and 40s. In 6 to 12 months, we hit stage 8. And stage 8 is where the transfer happens from people who own the wrong assets to people who own the right ones. Let me show you exactly what that looked like the last 2 times. In the 1930s, stocks dropped 89% from peak to trough. Government bonds defaulted. Corporate bonds collapsed. The people who came out the other side weren't the ones who diversified across paper assets. They were the ones who owned 4 specific things: physical gold, businesses with pricing power, short-term government securities, and productive farmland. In the 1970s, the same pattern ran again. The 10-year Treasury lost over 60% of its real value from 1970 to 1980. The S&P 500 went essentially nowhere for a decade, and when you adjust for inflation running at 7 to 9% annually, stock investors lost over 50% of their purchasing power. Someone who bought in 1968 didn't break even in real terms until the early 1980s. 13 years. 13 years of watching advisors say, stay the course while the purchasing power of your savings quietly evaporated. But those same 4 asset types did something completely different. Gold went from $35 an ounce to $850, a 24x return. Someone who put $10,000 into gold in 1970 had $240,000 by 1980. The same $10,000 in the S&P 500 became roughly $12,000 after inflation. Energy companies with oil and gas reserves saw revenues rise 700% as oil went from $10 to $80 a barrel. Agricultural land doubled and tripled. Short-term treasury securities kept investors liquid, ready to deploy when the best opportunities appeared. The pattern doesn't change. Paper assets collapse. Here are the 4 assets that survive when the machine breaks. The first is physical precious metals, gold and silver you actually hold. Not gold ETFs, not mining stocks, not paper gold. Physical metal stored securely. Here's the core logic throughout history. Every time a currency has been debased, gold has held its value. It's not an investment, it's insurance. In the 1970s, $10,000 in gold became $240,000 by 1980. The same $10,000 in the S&P 500 became roughly $12,000 after inflation. In the 2000s, gold went from $250 to $1,900, a 7x return, as central banks printed trillions. In 2025 alone, gold rose over 70% and silver over 140%. The market is already pricing in monetary stress. In good times, gold underperforms stocks. That's what insurance does. It sits there costing you a little while you hope you never need it. But when stocks and bonds are down 50%, that gold allocation is flat or rising, and suddenly it's the only thing standing between you and a delayed retirement. Target 10 to 15% of your liquid net worth here. Buy from reputable dealers like AppMax or JM Bullion. They ship direct or can arrange vault storage. For allocated storage, Bullion Vault lets you own specific bars in secured facilities. Start with 1-ounce American Eagle or Canadian Maple Leaf gold coins. For silver, 10-ounce bars or 1-ounce rounds. Expect to pay a 3 to 5% premium above spot for gold, slightly more for silver. Avoid numismatic or collectible coins. You want bullion, pure metal, nothing else. The second is businesses with pricing power, not index funds, not broad market exposure, specific companies that can raise prices faster than inflation, generate cash flow you can live on, and own hard assets or intellectual property that holds value when currency is being debased. Think about what this looked like in the 1970s. Most stocks went nowhere in real terms, but consumer staples companies like Procter & Gamble, Johnson & Johnson, and Coca-Cola raised prices when their costs rose, and consumers kept buying because the products were essential. When Tide's manufacturing costs go up 20%, P&G raises prices 25%. Consumers might trade down from premium to regular Tide. They don't stop buying detergent. That's pricing power. Energy companies with oil and gas reserves saw revenues explode 700%. Utilities with regulated returns passed cost increases directly through to consumers with a guaranteed margin. These companies didn't just survive the 1970s inflation, they expanded margins through it. The easiest way to find them today, the Dividend Aristocrats list, roughly 65 companies that have raised dividends for 25 consecutive years or more. They've survived every recession in modern history. Focus on 3 sectors: consumer staples, Procter & Gamble, Coca-Cola, Colgate-Palmolive, utilities, NextEra Energy, Duke Energy, and healthcare, Johnson & Johnson, Abbott Laboratories. Check the payout ratio. Below 60% means they have room to sustain dividends even under financial stress. Own 6 to 8 companies across those 3 sectors. Allocate 30 to 35% of your portfolio here. This isn't a growth play, it's a wealth preservation play. The third is short-term US Treasury securities and cash, and this is actually the most strategically important position in your portfolio right now, even though it sounds the least exciting. Here's why: when a crisis hits, the best opportunities appear exactly when most people are out of money to deploy. In March 2009, high-quality corporate bonds were trading at 60 cents on the dollar. If you had cash, you bought them. 12 months later, back at par, a 60% return with minimal risk. In March 2020, when COVID panic drove stocks down 35% in 3 weeks, the investors who doubled their money in 6 months weren't the smartest people in the room. They were the most liquid. Cash isn't deadweight. Cash is ammunition. Right now, 90-day to 2-year Treasury bills are yielding 4 to 5%, the highest they've been in over 15 years. That barely keeps pace with inflation, but it gives you the optionality to act when everyone else is forced to sell. When the Federal Reserve eventually cuts rates back towards zero, and they will, that 5% becomes 1% or less. Lock in these rates now. The simplest approach: open a free account at treasurydirect.gov and buy T-bills directly with no fees or commissions. Set up a ladder so bills mature monthly, giving you regular liquidity. Or use a brokerage account and buy SGF, an ETF holding 1 to 3 month Treasury bills. Trades like a stock. Holds only government securities. For cash equivalents, Vanguard and Fidelity both offer Treasury money market funds currently yielding around 4.5%, fully liquid, fully backed by government securities. Keep 20 to 25% here. The fourth is productive real assets that generate income, farmland, rental properties, infrastructure, things that produce food, shelter, and energy, regardless of what happens to paper currency. In the 1930s depression, farmland held relatively stable value in real terms while stocks and bonds collapsed because farmland produces food and people need to eat no matter what's happening in financial markets. In the 1970s, agricultural land doubled and tripled as food prices surged. Rental properties performed well because rents rise with inflation. Real assets have two properties that matter. They generate income streams that continue regardless of paper valuations, and their supply is genuinely constrained. You cannot print farmland. Most people access this through rate without the operational complexity of direct ownership. Gladstone Land Corporation, ticker LAND, owns farms across the US and leases them to farmers. Farmland Partners, ticker FPI, runs a similar model. For residential real estate, Realty Income, ticker owns over 15,500 properties and has raised its monthly dividend for 31 consecutive years. For broad real estate exposure, Vanguard Real Estate ETFs, ticker VNQ, holds hundreds of rate across residential, commercial, industrial, and healthcare properties. Allocate 10 to 15% here. So here's the complete framework: 10 to 15% physical metals, 30 to 35% pricing power businesses, 20 to 25% short-term treasuries and cash, 10 to 15% productive real assets. That's 70 to 90% in defensive positions. The remaining 10 to 30% is where you take calculated risks based on your age and expertise. Emerging markets, commodities, sectors you understand deeply. But the core is built to survive what's coming. Now, the mistake most people make after absorbing all of this: they understand the logic, they agree with the analysis, and then they do one of two things. Either they do nothing, they wait, they overthink, they ask their advisor who tells them to stay the course, because advisors get paid on assets under management, not on your treasury bills or physical gold. Or they overcorrect, they panic, sell everything at once, buy gold, and sit in cash waiting for a collapse that doesn't arrive on their exact timeline. Markets keep climbing for another year. Their gold goes sideways. They feel foolish and abandon the whole plan. Neither is the answer. Here's the systematic approach that actually works. Start by calculating your timeline. How many years until you need this money? If you're 35 planning to retire at 60, you have 25 years. You can reposition gradually over 12 months. If you're 58 planning to retire at 65, you have 7 years and need to move over 3 to 6 months. The closer you are to needing the money, the more urgent the repositioning. Next, sell the most vulnerable positions first, not everything, just the most exposed. Meme stocks, speculative crypto, growth companies trading at 100x earnings with no profits. Start there this week. Then systematically trim overweight index fund positions over the next 3 to 6 months. Don't try to time the perfect exit. Nobody can. Just reduce exposure to the assets most vulnerable in an inflationary debt crisis, then build the 4 buckets gradually over 6 months. Month 1, buy your first gold position, 5% of your portfolio, 1 or 2 coins from AppMex. Month 2, research dividend aristocrats, buy your first 2 pricing power companies. Procter & Gamble and Johnson & Johnson are solid starting points, and move 10% of cash into treasury bills. Month 3, add 2 more pricing power positions across utilities and healthcare. Add more to treasuries. Month 4, increase precious metals to 10% total. Add silver. Month 5, add real asset exposure through Realty Income or VNQ. Add 1 more pricing power company. Month 6, review your allocation. You should now be at 70 to 80% in the 4 defensive categories. The gradual approach has 3 real advantages. You average your entry points instead of trying to catch a perfect bottom. You have time to learn and adjust as you go, and it's emotionally sustainable. Small systematic changes are far easier to execute than one massive all-or-nothing decision made under stress. Finally, ignore the noise while you reposition. Markets will probably keep going up for stretches. People will brag about returns. Financial media will declare the bull market is back. None of that changes where we are in a 75-year debt cycle. Short-term performance is irrelevant. Long-term survival isn't. In 6 to 12 months, when we move into stage 8 of this cycle, the window closes, not slowly, quietly. The people who repositioned early will look like they got lucky. They didn't get lucky. They did the math. Here's what I want you to do this week, just this week. Open your portfolio. Go through every position. Ask one question: if we enter an inflationary debt crisis, Does this preserve my purchasing power? If the answer is no, market for gradual reduction, then write a plan, concrete, with deadlines, a rules-based system you follow regardless of what the market does, regardless of what the news says, regardless of how you feel in the moment, because in a crisis, feelings will cost you money. Fear makes you sell at the bottom, greed makes you buy at the top, hope makes you hold positions going to zero. A system protects you from your own worst instincts. This framework preserved wealth through the 1930s, through the 1970s, through 2008. The pattern doesn't change. Open your portfolio today. In 6 months, you'll either be glad you did or you'll wish you had.